This is CNNfN, the financial network.
This is a question that bugs everybody. What criteria should you use when picking stocks? Our next guest has some very good ideas and a track record to back it up. Joining me now is David Edwards, president of Heron Capital Management. David, good morning. Great to see you. Welcome back to the show.
Thank you.
So, you were last on
Halloween.
Halloween. Perfect. Perfect. And instead of being frightened by what you said, people should have really heeded. Let's go directly to some of the things you were recommending when you were last on, and let's see how they performed, starting with Pfizer, one of your picks. Tell us about that.
I would come in here every couple of months and talk about stocks that no one else seems to love. And back in the fall, everybody loved the technology stocks and nobody wanted to touch healthcare stocks. So we did our research and picked out 3, Pfizer, Merck, and Bristol Myers to talk about on this show. And all of them have beat the S&P over the last 3 months. Pfizer, it lead there 22.9%, but also 10.2 and 13.7 versus 8.8 on the S&P.
Let's move on to, as you're talking about these, let's bring along Merck and Bristol Myers, because the chart is the same. You look at back a few months and it's just nicely higher. There we have the Merck story as well. Mm-hmm. Yeah. And
that's my job, basically, is to see what else, what everybody hates, and see is there value there. And that kind of leads into our conversation today. Every January we need to take profits on what worked last year. In last year's case was large cap technology stocks in particular. This year we're moving back to the mid cap universe.
Okay, so from large cap you say back to mid cap. Let's start by looking at, we're talking about what are the criteria used for picking stock. Let's talk about what the criteria are, because again, I think people read books, they hear people talking. Sure. Let's walk through some of your notions about how we do this.
There's no single magic bullet that's going to pick you a stock every single time. So we use multiple criteria, multiple screens. When I began this research in the beginning of January, I first went to my quantitative screens. I love companies with positive cash flow. They don't need to go to Wall Street or to the banks to get money to keep growing their business. Microsoft, classic cash cow. Mm-hmm. Wide operating margins. If you're a grocery store with razor-thin margins, you don't have a lot of room to discount or market. But if you have a wide operating margin, you have a lot of room to maneuver.
Okay.
Forward growth rates in the 15 to 30% area. The S&P in general is supposed to grow about 11% over the next 5 years. I like stocks that have larger potential, according to the analyst estimates, but not so crazy. Plus 50% is not sustainable for more than a year.
Okay.
So
your final one was low beta. Let's explain what that is, and is that something that a regular investor could access easily?
You can pull it up on any number of free market data services. Beta is a way of juicing your portfolio because certain stocks are well loved and everyone piles into them when the market's going up and they go up twice as fast as the market in general. That would be a beta of 2. I like stocks that have betas of between 0 and 1. They'll go up with the market, but they won't collapse when the market collapses, because the stocks people love, they ditch the first when they want to get out.
Okay, and before we move on to your qualitative, I want to also ask about forward growth. Again, something people can access and explain that. I mean, we can kind of get it, but specifically, what is that? Why is that so important?
The Wall Street analysts put out their research, and they try and come up with a 5-year estimated growth rate for the companies that they cover, and the growth rate might be 12.2%, which is ridiculously precise for 5 years into the future. However, we've seen over time that on aggregate, if 15 analysts say that this company ought to grow at about a 16% rate versus 11% in the S&P 500, it probably will grow faster than the S&P, and that's useful information to us.
So now we've got the fundamental criteria up. Let's walk through those as well. Having, say, market share of being the first or second, that seems like pretty easy to determine when you look at stocks. And why is that so important?
Let me explain the process a little bit. We use the quantitative criteria to get from several thousand stocks down to a couple hundred.
Okay.
And then we use that list to go in and find the companies we actually want to
really invest in. Okay, sure.
And this part is not trivial. You got to read your news. You got to look at your trade magazines.
Okay.
Right? But generally speaking, it is relatively simple to figure out who's number 1 in market share. Microsoft is number 1 in desktop market share.
Okay. What was number 2 on our list? There we go. Better, faster, cheaper. Okay.
All right. Revenues accrue to the company that can do things better, faster, and cheaper than anybody else. And as time goes by, you get network effects. Again, Microsoft wasn't better, faster, or cheaper in the beginning, but they are now.
Give us another example of a stock right now in its sector that's better, faster, and cheaper.
Dell.
Dell, okay.
I love Dell.
Yeah, well, they're definitely number one for market share, right?
I think they're number one or number two. Depends on how you look at Compaq and HP.
Number 3 on our list is, here we go.
Yeah, this is back to the 49ers.
In a gold rush, sell shovels.
Who got
I
rich
like it.
in the gold rush? It was the guys who sold the shovels and the guys who sold the blue jeans. And this is particularly appropriate when you're examining biotech stocks, because I have no PhD in biology. I have no particular insight into what company has the lead in genetic research. But I do know that these companies use a lot of instruments and chemicals. And so I try and look at the companies that are selling instruments and chemicals to biotech.
2 more quick questions I want to get in. What's high switching costs?
If it's very painful to go to a different company. If you invested in Oracle, it's very hard to switch to a different company.
You said now, and for now the strategy, we were here, you told us at Halloween, it's almost Valentine's Day, we're going to love this. So what's our basic strategy now? And you give us a couple of stocks.
All right, well, the large cap universe, I think, is pretty well fully valued. And you see that in the price to sales ratios, price earnings ratios. But the mid caps, they're trailing somewhat. And the other thing that's attractive about mid caps is, if you're Microsoft, you've got to double your price to sales. Your stock, you have to double your price to sales by $33 billion. Where if you're a much smaller company in a secure and growing market, you have to go from $1 billion to $2 billion in sales.
Couple names?
The 3 I brought up today were Fair Isaac. This is a company that you probably haven't heard of, but should have heard of because of credit scores. Applied Biosystems, Instruments and Chemicals for the Technology Group, and First Data, largest processor of credit card transactions. We're
going to have you back, but we're not going to wait so long this time.
All right.
David Edwards, thank you for joining me.
Thank you.
Appreciate it.
This is CNNfN, the financial network.